A bank account can look perfectly ordinary and still be used mainly as a transit route for money. I have built the monitoring designed to catch that behavior. So let me show you what this behavior looks like, how monitoring catches it, and one documented case. Here is the operational definition I use. Money arrives, remains briefly, and most of it moves onward without a credible reason for the account to sit in the middle. I am describing behavior, not a special bank product or a legal label. Fast movement alone is not suspicious. Context turns it into a meaningful alert. Imagine a small consulting company expected to receive about 25,000 euros per month. On Monday, it receives 18,000 euros from company A, 12,000 from company B, and 10,000 from company C. That is 40,000 euros from 3 companies with no obvious connection to its consulting work. Within 24 hours, 19,000 euros goes to company X, 12,500 to company Y, and 6,500 to an individual. 38,000 of the 40,000 euros has left. Only 2,000 remains. The monitoring now sees 4 signals together. 95% moved onward within a day. One day exceeded the expected monthly turnover. The senders and recipients appear unrelated, and there are no recognizable consulting expenses such as payroll, tax, or rent. Compare that with a normal consulting account. It may receive the same amount, but use it over time for salaries, taxes, rent, suppliers, and working capital. The difference is speed, retention, counterparties, and whether the activity makes sense for the customer. The purpose is layering, inserting another account between the source and final destination. It does not erase the audit trail, but it makes the flow harder to follow and the onward payment look further removed. The first detection block measures velocity, how quickly incoming value leaves again. Then it measures retention, how much remains after a defined period. A scenario can examine the share moved onward within hours or days, calibrated to the bank's customers, products, and risks. 24 hours and 95% in our example are teaching numbers, not legal thresholds. The second block looks beyond one transaction. Are many parties paying in? Does the account immediately distribute funds to new or unrelated beneficiaries? Do related accounts repeat the pattern across products or channels? Network and counterparty analysis turns isolated payments into a visible flow. The third block asks whether the behavior fits the customer. Compare amount, frequency, counterparties, geography, and purpose with the customer's business and expected activity. Then ask the practical question, what genuine economic role does this account play between the sender and the recipient? The strongest alert combines speed, low retention, network structure, and profile mismatch. There is no magic threshold. This matters because legitimate payment processors, marketplaces, treasury functions, and collection accounts can also move money quickly. An alert is not a verdict. The analyst checks source, destination, purpose, relationships, contracts, or invoices, and whether the explanation matches the data. A credible explanation supported by evidence may close the alert. FinCEN's 2024 consent order against TD Bank gives a documented example of closely related funnel account activity. According to FinCEN, a bank employee accepted bribes and opened numerous accounts, including accounts for apparent shell companies. 5 accounts belonged to U.S. incorporated companies controlled by Colombian nationals. Over about 8 months, those accounts conducted more than $20 million in transactions. They received approximately $12 million in wire transfers, followed by approximately $12 million in cash withdrawals at ATMs in Colombia. FinCEN said the rapid movement showed clear indicators of funnel account activity. TD Bank took an average of 5 months to file suspicious activity reports and 8 months to close the 5 accounts. The wider $1.3 billion penalty covered broader admitted AML failures, not these 5 accounts alone. A well-designed system should bring those facts together. That means shell company accounts, profile mismatch, rapid cross-border movement, unusual withdrawal geography, and related accounts open through one channel. It should route the combined case to an analyst with the full transaction chain. The alert starts the investigation. It does not decide criminality. Under Article 26 of Regulation European Union 2024-1624, obliged entities must monitor transactions against their knowledge of the customer, business activity, and risk profile, where necessary. That includes the origin and destination of funds. Article 34 requires closer examination of transactions that are complex, unusually large, conducted in an unusual pattern or lack, an apparent economic or lawful purpose. AMLA's June 2026 draft guidelines add practical expectations around linked activity, customer due diligence, explainability, testing, and recalibration. They are draft guidance at the time of this video, not final rules. My operational definition is simple. A pass-through account moves most incoming value onward quickly, while the account itself adds no credible economic purpose. But never build that as one blunt rule. Combine velocity, retention, counterparties, customer profile, and a reviewable explanation. The thresholds stay risk-based and must be tested against real customer data. At GK Consultancy, we design, tune, and explain monitoring scenarios so the logic works in the data and holds up in review. If you are rebuilding AML monitoring or training investigators, get in touch at info@gkconsultancy.d. Thank you, and good luck for now.